Let's start today by taking a look at the Indian stock market. And as I said, we do have two of the biggest voices in the Indian stock market to tell you what you should do. Should you be buying right now, selling right now? What should you do to take advantage of the stock market and the potential bull market that we could see there? But let me just start by giving you a little bit of a background to all of this. Look, ever since the COVID-19 pandemic broke out more than 3 years ago, the world has been caught in a spiral of unintended consequences. All sorts of external factors are playing themselves out. There was lockdown, of course, in a large part of the world, which froze economies, which then resulted in central banks injecting a large amount of liquidity into the system. That had its own effect. Then the Federal Reserve's early message of inflation being transitory turned out to be wrong. And the US now perhaps faces its most severe inflation in more than a decade. If all of this wasn't enough, highly volatile geopolitics have caused havoc on the supply side. It's been a year since Russia's invasion of Ukraine. The war shows no signs of ending. And meanwhile, the issue of Taiwan and what's going to happen between Taiwan and China is once again becoming a problem area and a potential source of tension between the US and China. Now, here in India, it's not been an easy task for either the government or the Reserve Bank of India to balance the risks and yet continue to encourage growth. However, despite this, the recovery seems to have been fairly strong. The Indian economy, according to most estimates, poised to be the fastest growing economy in the world, certainly the fastest growing major economy. The risks to the economy at this particular point appear to be external rather than internal. So where does all of that leave the Indian stock markets? The last year has been quite volatile for the markets. Although there was heavy selling by foreign portfolio investors, it was offset by strong flows from domestic institutional investors and also, and this is an interesting change, also from Indian retail investors. In 2022, FII sold Indian shares worth $17.2 billion, the multi-year low for that. In March, FIIs, though, were net buyers of Indian shares worth $1.8 billion. So far, though, on average in 2023, they've also still been sellers. $2.2 billion or thereabouts are the latest figures. So they have been selling for a consistent period of time. Started buying in March, but we don't know where that's going. What's the road ahead? What's the outlook for the Indian markets? What should investors like you be doing? Well, who better to talk to than two of the biggest voices, two of the most respected voices in the Indian stock market. Well, I was in Mumbai this week and I got a chance to catch up with Ramesh Damani for this very special interview. Let me start by playing it out for you. Well, over the years, one thing which I have come to realize is that if you really want to understand what's happening in the Indian stock market, one person you should talk to is Ramesh Damani, which is why it's wonderful to be with you here in Mumbai, the business heart of India. Come, Ramesh.
And at Nariman Point, the business heart. But thank you so much for your kind words, Vikram. It's very kind of you to say
No,
that.
it's always. You always know exactly what's happening.
I wish.
So you're going to tell us down to a percentage point as to where the Sensex is going to be next Monday or
exactly.
next week.
And never come on your show again.
Okay, so it's always very difficult to predict, week by week. Short-term fluctuations are there, no one can predict them.
Yeah.
But I want to just start by getting from you the broad directional sense, because something which I've always heard from you, which has always been very good advice, is don't worry about the day-to-day fluctuations. Keep your eye on the big picture. So what's the big picture on the Indian stock market?
The big picture, the first big takeaway for your viewers, Vikram, is that the bull market that began a few years ago is well and truly underway now. And bull markets typically run for a period of time, and so will this run. So the next question that I'm always asked is, what is propelling the bull market? Now, every bull market tells a story of its own. The 92 bull market spoke of India's liberalization, the 2000 of India's technology superpower. So what is this bull market telling you? This bull market is driven by two forces, the two Ds I call them. One, of course, is demographics, and the other, of course, is digitization. And those two currents are propelling this bull markets further. And if you want, we'll take up each of these separately to try and understand how they're propelling this forward.
You said a bull market which began a few years back. When do you think it actually began? Because you could say it began after the crash that we saw in 2020. You could also say that 2020 was an abnormal event caused by COVID. So the bull market actually began earlier. That movement from 38,000 to 60 for the
I think it began the day the finance minister, Mrs. Sitaraman, argued that Indian corporate tax should have gone to 25%. If you remember, the index was up a few thousand points at that particular day. I think it was in 2019 or so. And while COVID tested that bottom, it didn't break at the bottom. It rebounded very quickly. And I think the reasons that bull markets are not very visible when the bull markets start, but as the bull market progresses, they become more and more obvious and plain as, you know, the horizon here is that there is a bull market and there's some economic reasons propelling this bull market ahead.
But at 60,000, the level is not, or the Sensex is not radically different to what it was in the last 2-3 years. So it's not that there's been a substantially big jump.
Well,
it's been flattish.
I disagree. In the last bit, and the COVID lows, which is about 3 years back, index was
30,000. You could say was an abnormal low, right?
But that's the buying opportunity people get.
Yeah.
60,000 has been fairly new territory for the index, which has reached only in the post-COVID, in the COVID period, if you will. And you know, indexes never give you linear returns, you know, Vikram. They zig and zag and they go ahead and they, you know, they test your patience and they reward your conviction. So if you want to remain invested in India, let's take an example. I came back and started my business in 1989. The index was 600 at that time. So from 89 to 2023, any bad thing that you can think has happened to India. We've had the global financial crisis, we've had governments change, we have the communists come into power, we had plagues in Surat, we had Kargil, and yet the index is up to 60,000. That speaks to the remarkable resilience of the Indian economy and also the power of remaining invested. So as a lot of wise people have said in the stock market, it is not timing the market that is as important as time spent in the market. And I think the next 10, 20 years will be more of the same. The time spent will be more important than timing the market.
Okay, so that's the big picture, right? Get into the market and stay invested in it. And if you stay invested for a long enough period, you will make good returns.
Right.
And that's the big story of how you make wealth. You get into it and you stay in it for a long period of time. Keep your eye, 5 years out, 6 years out, 10 years out, that's what you should do?
We're now extending the time frame to 10 years, 20 years horizon because I'm investing for my grandchildren, Vikram. I'm sure you'll appreciate that. I'm looking from their college point of view. But that's not the point. The point is when I came and started my business, the index was about 6,800, the Sensex, 6,800, it's hard to believe it was in triple digits, all right? It's closer to 60,000. And if you look back at the last 30 years, a lot of things have happened in India which are not very bullish. You know, we had the global financial crisis, we had governments go, we've had Kargil, we've had, n number of bull markets end in India. And yet you see, over time, the markets plot ahead. So my feeling is the Sensex, depending on the two time frames you take, the lows and the highs, compounds at a rate of between 14 and 16% a year. That is without dividends. No reason to believe the next 5-10 years will be worse than that.
So 14 to 16%, let's just try and understand that number. People are in the power of compounding. If you think 14 to 16%, you're pretty much looking at the Sensex, doubling within 5 years?
Doubling every 5 years, yes.
Doubling every 5 years, so it's 60,000 right now. By that logic, it will be 1,20,000 in 5-6 years.
It'll be a six-figure plan that you can come back and interview me.
2,40,000
in 12 years' time.
12 years from now.
Yeah, it should be there. I mean, that's the inherent growth rate. And in fact, I believe that we're at such a sweet spot right now that maybe we'll do better than 16%, maybe a couple of percentage points
16% of course is at nominal rates, right? So there's inflation of 5-6%, but you're still getting 9-10% real.
It's the best asset class you have.
You said there were two factors driving it. Demographics. Let's discuss that first, and then I'll come to digitization.
Yeah. Let's discuss demographics. India and China both have a similar population now, 1.4 billion people. Over the next 30-40 years, India will become 1.7, 1.75 billion people, and China will decrease by that amount. And in the stock market, we have a strong saying that demographics is destiny. And what that means essentially is that the average age of an Indian right now is about 29, 30 years. Which means that he was just born post-liberalization of 91-92. And that's extraordinary. We were all products of a generation born in socialism, born in the 60s, born in the 50s in India, right? This is a generation that is now speaking English, is connected to the net. 95% of the people have smartphones with them, are globally connected, don't belong to socialist Raj, and they belong to the aspirational class of India. And that demographics of India being 1.7 billion people is going to drive enormous change in India. In fact, some economists said that this generation of India, the generation of India born after the 1990s, is probably going to be the biggest source of consume and the biggest source of labor in the knowledge and network economy. And now if you look around you, you can see how people use the smartphones, how businesses are created using the smartphones, how UPI, Aadhaar are all
And that's the second thing you were talking about, right? Digitization, that you've got demographics, but
Right.
it's connected to a digital ecosystem and a digital backbone and an India stack that is probably one of the most advanced in the world. So for the first time, normally you say Indians struggle to do well in a time when infrastructure and everything is bad for them.
Right.
But here, the digital infrastructure actually that India is running off
Is
is
world-class.
probably better than anywhere else in the world.
Yeah, it's a great point because in our generation, one of the highlights was when Neil Armstrong walked the moon. And if you remember, Vikram, when he walked on the moon, he said, it's a small step for man, but a great leap for mankind. And India's digitization is India's moonshot. And there are two pillars to it. There's a domestic component to it and an international component to it. The domestic component, of course, is, as you mentioned, we all have the Aadhaar card, we all have smartphones, we all have UPI, and we all linked together. And India did, I think, last year, 8 billion transactions worth over 200 billion. That's almost 4x what US, Britain, Japan, France did combined basis. Yeah. So the digital infrastructure is now dwarfing the physical infrastructure. And we're using Paytm and UPIs and to transact for little as a cup of tea for 50 bucks. And it's frictionless and it's zero cost. Just imagine the possibilities of businesses expanding because of that. The amount of money going directly due to Jan Dhan schemes that employees have. So that is one part of the digitization debate. The second part is what COVID brought to the front, is that increasingly the world is relying on India's digital technologies in order to improve and enhance their own societies. And rather than coming in pure tech and service, which is probably a bit challenged right now, it is coming in knowledge-based processes. For example, law work, medical work, high-end legal work. All that is now coming to India because the cost of communication is cheap, the cost of office is cheap in India. Yeah. And those specialized BPO or KPO firms will have secular growth paths ahead of them, almost manifest in many, many professions.
Till AI changes all of that, but that's a separate question.
That well may, but I think we'll still create some additional jobs for that.
Okay, so when it comes to the point of view, where do you invest in all of this? Which are the sectors you're looking at? You, for example, I see are still invested in some, there's also physical infrastructure being built, and many people would say that that's the place to be. In defense, I see you've got positions in a lot of defense companies, which is again another area. These are not either of those trends, but this is another thing which is happening, which is the building of some amount of physical capabilities as well.
The key in the stock market is you got to invest at the right price, buy it cheap. So the physical, the defense and the railways. See, the government of India is leading the capex drive. And the sharp edge, the blunt edge of the capex drive is they're expressing it through the railways and through the defense companies. That's how the government does it, through road building, right? So these companies were listed and they were a very attractive price. So it didn't matter whether it was physical or virtual infrastructure, they were just cheap. So we bought those. But to give you an idea of something more forward-looking that we're thinking of, a lot of governments, including India, set a very strong ambition of carbon-free, zero carbon by 2050, 2040, things like that. The opposite of fossil fuels is, of course, electricity. So there'll be a huge surge in electricity out there. And two things that would stand out are copper, which is almost like a required material or metal for electrification. And of course, the infrastructure build out. Who builds the transformers, the gears, the connectors to all this. So one other theme, other than what you could look at in terms of the physical defense and railway infrastructure, would be, for example, electrification. And there are a number of ways that you want to play that theme. And I think it will become very prominent. I mean, India has very limited amount of capacity in copper. There are only a few companies doing that. And so the good way to express yourself is to buy perhaps those companies.
And the demographic theme, because they're done, should we sit down for a minute?
Sure.
It's nice here, yeah. So the infrastructure theme, the demographic theme would be what, FMCGs?
Yeah, I mean, demographic themes plays out in different ways. It plays out in more housing, more savings, more banking, more education, more travel. So generally the consumer economy will tend to do well. These, of course, have been slightly slow growth places in the last few years. But I think as, I was from your hometown, Delhi, a few weeks ago, and we met some very interesting companies that are trying to reach to the last mile of Indian villages, the one that everyone ignored and could not be connected. They're using innovative digital apps. So my feeling is that that part of the app economy will also do well.
Now let's look at the bear case. What could go wrong? Social unrest, is that what could go wrong? Political instability, Indians fighting with Indians,
I think
people
so.
getting shot on television.
I mean, social unrest is actually more likely to happen into our great Asian rival, China, because, well, everything seems calm on the surface out there. Sometimes it's a cauldron underneath it. While India, everything seems disorganized and disoriented in the surface, underneath the country moves on. And I think the country will move on. It has a democracy. People vote, people elect the government, and people accept the government. I mean, you had, I think, 600 million people vote in the last election. 90 million of them were first-time women voters. These are the aspirational class. And that is going to make a strong statement that good politics makes for good economics also.
All right, so last word, if you have to tell anybody what they should do with their money and where they should be investing it, by the way,
Well,
in the sector.
My first hypothesis, which I've always been saying, is remain invested. That's the first thing you need to do. I think we are at the right place at the right time in history, and I think this generation of India, born after 1991, has a chance to go down as what we call the proverbial greatest generation, because the economic opportunity, we are becoming the center of the universe in a manner of speaking because of our demographics, and because of our digitization, we first time have the skill sets to compete with the best in the world. So my great advice is remain invested, buy great quality companies, and hopefully you'll see me back when the index crosses 6 figures.
We'll be back talking to you well, long before 6 o'clock. We're not going to let you get away that easily, Ramesh. We'll keep coming back with you to touch base on how things are going. And therefore use every dip as a chance to buy. Would that be also your advice?
Definitely don't use every tip as a buy to buy. Find great businesses which have great cash flows and remain invested in the business with a conviction. As Warren Buffett taught us, that a stock is not a price that moves up and down. If you made 20 bucks, it's not necessarily a good stock. But you buy a piece of the business and spend some time doing it. And if you can't do it, if you cannot, for example, buy individual stocks, you don't have the time, don't have the inclination, buy an index fund and you'll ride the prosperity along with the Sensex.
All right, so there you've got it. That's how you can take advantage of this India story that we've been talking about at great level. You can actually take part in it. You just buy good companies and ride them for a long period of time. Thank you so much, Ramesh. Always a pleasure.
Thank you, Vikram. Always a pleasure.
Thank you. Ramesh Damani there, clearly bullish on the India story and what that means for the Indian stock market for the next few years. Well, let's get a second opinion on that now. It's a great pleasure on the India story to be joined by somebody who really influences the market, Raamdeo Agrawal, the chairman of Motilal Oswal and one of the most respected voices in the Indian market. Raamdeo, thank you so much for joining us here on the India story. Just wanted to get your sense on where you think the markets are going. Last year has been fairly flattish in a sense. Where do we go from here?
Yeah, markets are actually doing well, despite given the fact that in last 1 year, earnings have been quite muted. And actually even Q3 was not good. Top line growth was about 15-16%, but bottom line was flattish. And X of financials, the earnings were rather disappointing. And one can understand all kinds of cost pressures where logistic costs have gone up, energy costs had gone up. So all the companies, they're not able to pass on their cost escalation. And now that same cost is coming down, some amount of passing on has happened. So my sense is Q4 performance of the companies, particularly manufacturing and all, will be better. And as we go into the year, unless there's a new source of some trouble, I think we are going to see a sustained build-up in the margins. The economy is doing well, so demand side will be very strong. The issue is that whether companies can pass on the rising cost. I think we have got over the hump, and the next year it looks that earnings build-up will be pretty good, and hence market should also track that.
So before I come to the long term, if you're looking at the short term and the medium term, the next 4 months, 6 months, 1 year, do you feel that the corporate earnings are likely to be good and so the EPS will be strong and therefore markets could be buoyant for that reason? Then, of course, you will be heading into political questions closer to the general elections and other elections.
Yeah, so I think this is also a year of election coming in, and but then the budgets were very. No, it was not what I would say. It was not impacted so much by the upcoming election. The finance minister managed the glide path correction from 6.5% to 5.9 in fiscal deficit. But actually, to be fair, this is probably the first full year of recovery post-COVID. Last year, at least till June, it was impacted by COVID, and it takes time to build up the revenue base. But if you look at the one high frequency but very high quality data, there is a tax collection on GST every month. So for the month of February, it got released on 1st of April. 160,000 is a very robust data, I must say. For March, I think we should be somewhere around 175 or something like that. So I think if the government tax collections are good, it also means that, of course, it is more to do with the on inflation also you collect tax. But broadly, 160,000 is a good taxation. And that means that next year government expenditure will also be very robust. Demand will be robust and economy in full swing on a falling prices. Today we have seen the WPI has come down to 1.5–2%. So that's a good sign. So inflationary pressure is getting subsided. And even Ukraine war has now become, daily affair kind of thing. There is no, of course, it's a big war, but I think it is now, market has taken it on its side. If by chance some ceasefire or something happens, I think that will be added advantage.
So in short, Raamdeo, you're saying that you think it's going to be a good period ahead. Now, you and others have been advising retail investors and others for a long, long period of time that the real way to make money is to get into the markets and stay in it for a long period of time. So far, they've not often been listening to that, but now they are starting to listen. These monthly SIPs that we are seeing into mutual funds, what is it, 14,000, 16,000 crore rupees a month. So good retail participation now. What is your long-term prognosis for them? Are you still saying stay in the market long enough because it could be 100,000, 120,000 in the Sensex within a few years? So ride that.
Yeah. So, Vikram, the issue is that India had a compounded past. In 75 years has been, you have gone through all the ups and downs. You have seen global politics, global geopolitics, local politics and everything, fragmented government, whatnot, famine, drought, everything. And yet India is where it is. And when you look, it just compound the same numbers into next 25 years. We have seen, despite everything, nothing changes in the sense that nothing meaningfully changes. India survives. It's like elephant just walking through. So I think if you look at the compounded future, if I say we had compounded past, we'll have compounded future at the same pace. Don't accelerate anything. Then also, if you do the number for next 10, 15 years, it looks, and there are not too many countries which can claim this particular thing. You look at Germany, you look at Japan, you look at France, you look at so many countries which are at around $3 trillion. In the top, leave aside, China is a glaring story in the last 25 years. America has been steadily going up, and that's why they are leader, larger than 25 trillion. So India has a chance of going from 3–4 trillion. It's just a chance to go to 7 trillion in next 6–7 years. And then from there to build up. What more to say beyond that? But I think this is one of the most exciting story. India to become third largest economy.
And Raamdeo, I guess it would be fair to say that the power of that compounding is when you're a larger economy is so much more. It's okay if you're compounding at 6% or 7% when you're a smaller economy. But if you're a $3 trillion economy and you start compounding at 6% or 7%, the impact is massive because you're adding, what, $200–300 billion to your economy every year.
Much bigger. So about $300–400 billion of GDP. And what happens, you must have seen that ordering of planes, is 70s, 80s, ordering 5 jumbo jets, every jumbo jet was given name, Chandragupta, Ashoka, those kind of things. Today, one airline company is ordering 500 planes. Another airline is ordering another 500. So there is a competition who can order bigger. So, this is a change of the scale. I don't know what happens. What will be the size of ordering when we reach $7 trillion economy? Because aviation will be all over. And number of people who are flying, there are hardly 5–7% people are flying right now. Okay. If that goes to 20–25%, what happens to the discretionary consumption build, which is going to happen in next decade after that? I think it's a very exciting time. We can discuss numbers, macro numbers, to best of my understanding.
Okay, let's look at the bear case now. People do believe that there are things that could go wrong. For example, unemployment. We've just been talking about the fact India is the largest country in the world in terms of population. Could be a benefit, could be a negative in case unemployment builds up, in case jobs aren't available, in case there's social unrest. Commodity prices could go up, wars could happen. What do you feel are the factors that could go wrong now?
See, I'm an optimist per se. What I've seen at the end of it. See, it's not that all those problems were not there. I think the biggest problem India had till '92 was the forex. And we literally came to where Pakistan or Sri Lanka is today in 92. And from there to build from 7 days coverage of imports to now $650 billion of reserve. That's, I think, one of the biggest unsung story of India. And, any country can do everything, but they cannot print Forex. And now we have adequacy of that. And you see, every week we are getting $5-7 billion. My sense is, I think this quarter we could be having current account maybe plus or minus types. So is it only one quarter? Does it become a trend? We'll see what happens, but quite possible that 3-4% every year, devaluation of India rupee vis-a-vis dollar, that might be thing of past, but it's too early to say that.
All right, Raamdeo, thank you so much for joining us. Look forward to meeting you when I'm in Mumbai next. Thank you so much for being with us.